Hi, I'm Chris Wood. I'm an accounting advisory services partner at PwC Canada. The new impairment requirements are so overwhelming that it's natural for financial institutions to focus the majority of attention and resources on it. At the same time, there are only so many ways to measure financial assets, so at first blush, it can look like the classification and measurement changes in IFRS 9 aren't so bad. The thing to keep in mind is that the overall bias has shifted from fair value through other comprehensive income to fair value through P&L, and even if you end up in the same spot, the way you get there will be entirely different. Derivatives and equities are easy because they're always at fair value. What's complicated now is applying the new two-part test for debt instruments that requires you to look at cash flows and business purpose. From a cash flow perspective, we used to look at an instrument, and if we found impurities like embedded foreign currency or other derivatives, we'd actually separate them out at fair value, and we could measure what was left at amortized cost. Instead, now we look at the instrument on an overall basis and ask ourselves whether it's sufficiently pure to be at amortized cost or fair value through OCI, or whether there are enough impurities that it needs to be at fair value through P&L in its entirety. That sounds easy enough, but what it really means is that we've got to throw out the work that we did in the past on embedded derivatives and go back to all of our contracts to reassess the cash flows under a new test. For the business purpose, we need to figure out whether we're holding the instrument in a portfolio where our objective is to collect contractual cash flows, to sell it, or both. Again, that's not something that sounds terribly complicated, but it can give rise to some pretty interesting questions that require judgment together with some operational soul searching. Ultimately, these lead to the really important question, which is what's going to be the impact on my balance sheet, my capital, and my financial performance going forward. Don't forget about the knock-on effects in areas like income taxes as well. The good news is that if you start now, there's still time to consider these potential impacts and make changes. So what's our perspective on classification and measurement? Don't underestimate it, start now, and understand that getting to the right big picture is going to take a lot of work in the details.